I look forward to our first panel this morning. So it's on the topic, the future of credit insurance under Basel regulations for banks. Credit insurance is a fundamental risk mitigation tool for banks, and we want to focus on Basel regulations, so Basel IV for Europe, and the impact on the use of credit insurance by banks. So we look into the interaction between the banking regulation and insurance and Basel IV, and the discussion will also be extended by looking into statistical key figures that are coming from global credit data as part of the data pooling exercise. So first of all, I would like to ask my panelists to introduce themselves.
Good morning, Robert. Thank you very much for having me here. My name is Silja Kalak. I'm working for Banco Santander, where I am in charge of private debt mobilization for documentary trade finance and supply chain finance. But I'm also a member of the board of ITFA. ITFA is the International Association for Forfeiting and Trade. And we are an association, international association, bringing together banks, financial institutions, and insurances, all involved in trade finance or transaction banking. We were founded in 1999. We have over 130 members in 60 countries all over the globe.
And yes, thanks also. It's a great pleasure to be here today. My name is Carol Searle. I am General Counsel at the Texel Group, which is an independently owned and specialist credit and political risk insurance broker. And I am also part of the insurance committee working with Celia and ITFA.
Thank you for having me and for the opportunity to be here. I'm Jakub Tomczyk. I'm the risk analytics executive. I work for Global Credit Data, and Global Credit Data is a non-profit association with 50 member banks who are actually also the owners of our association, and we support various initiatives by providing statistical evidence. And within GCD, I'm responsible for relationships with banks, regulators, and industry associations.
Great, so thank you very much. And well, I think we are starting off with the simple questions. Why do banks use credit insurance?
Banks use credit insurance mainly for three reasons. The first one being simple risk mitigation. Yeah, I have a transaction in a country where I'm afraid that there will be a civil war. So I can take political risk insurance. I think this reason has lost in importance for the banks. The second reason would be capital and credit enhancement. So I need more credit capacity. I have a customer who wants me to set up a supply chain financing of 1 billion. I will probably not have a credit capacity of 1 billion for this one customer. So I need to have the help of an insurer to improve my credit capacity. The third one is risk-weighted asset enhancement. And here that we will discuss this a bit later. You will learn more about it later. But I think this is the most important reason now for banks.
Yes, and that does sort of align very much with what we at Texel see with the way our client banks are using insurance. And also supported by a survey which was conducted last year of a number of banks, a survey done by ITFA and IACPM, when it was asked of banking members of these associations, you know, what are the reasons why you are using credit insurance? And you will see here that actually, as Celia says, a key goal for insurers is to increase their ability to lend to their customers and comply with internal credit limits. But importantly, for our discussion today, the second most important portfolio management tool for banks is to achieve regulatory capital relief. And also another important slide that you'll see from the survey results is the volume of lending that is supported by insurance. And this survey was conducted 2 years in a row. In 2021, there was a survey conducted, but the results in 2022 show an increase of 20% in the amount of lending supported by insurance. In 2022, the banks who replied to the survey had loaned $360 billion, of which 166 was supported by insurance. And of that 166 billion, 70% was used to achieve some form of regulatory capital relief. How does it fit with what you see, Celia?
Yes, absolutely. That's what I see in the bank. I would say about 2/3 of the risk mitigation I do in our bank is somehow related to risk-weighted assets, either in order to reduce the risk-weighted assets because we have only a certain budget corresponding to the equity of the bank, or in order to increase the returns we have on these risk-weighted assets by reducing the risk, so the returns we have on it will be improved.
So, looking into the details, why is and how is banking regulation relevant to banks buying credit insurance? We covered that, and how does it work in detail?
Yeah, so it's all about regulatory capital and the Basel rules. And the main risk, as everyone knows, that banks face is credit risk and the risk that a loan will not be repaid. So because of that, regulators they impose a capital buffer of around 8%. And that means for every loan that a bank makes, they have to retain a regulatory capital of 8%. But banks also have the ability to risk weight assets. And what that means is if you have a risk weighting of an asset of 50%, on a loan of $100 and risk weighted at 50%, instead of keeping an $8 regulatory capital, you can keep $4. So it reduces the amount of capital that a bank has to hold. So what does it mean by a risk weighting asset, and what do you do with that? And basically there are different methods that a bank will use to risk weight an asset. Standardized approach is used by a lot of smaller, less sophisticated banks. And here the regulator presets how the asset can be risk weighted with reference to rating agencies tables. So for example, a AA minus and above corporate will have a risk weighting of 20%, but if an A-rated corporate would have a risk weighting of 50%. The other method, which is going to be important for the discussion on Basel IV, is when banks calculate this with reference to their internal models. There are two ways it's done, either on an advanced basis or a foundation basis. In both cases, an advanced internal model-based approach and a foundation approach, a bank can calculate their own probability of default of a borrower. But the second very important component is the loss given default, which is the LGD. A foundation bank has that preset by a regulator, but an advanced bank is able to model that themselves. So why is this relevant to credit insurance, you're probably saying? And that is because the other thing that the Basel rules allows a bank to do is to substitute the risk weighting of a borrower with that of a provider of credit risk mitigation, such as an insurance product. And very often, the risk weighting of an insurance company will be lower than that of the borrower, and that can allow you to hold less capital against that risk. So, yeah, hope that was...
Right. If we look into some more technical issues, maybe we could refer again to what is being expected in the technical terms of LGD, and if you maybe could elaborate what it would mean, especially from Mink.
So I think we probably want Celia to deal with the technical points, being the banker in the room. But before you get to what Basel IV is doing on this risk weighting of assets, the intention of Basel IV was to reduce the deviation in regulatory capital produced from modelling. And the aim here is to constrain the use of internal models. And this is done by determining or limiting the way an advanced bank can use its models to achieve a regulatory capital reduction. So I think at this point I'll ask my banker friend to
Right.
explain this in more detail.
Yeah, so as you said, Carol, the regulator wants to have a level playing field. They don't want to have IRBA banks such as Banco Santander to have such a more favorable position when calculating their risk-weighted assets compared to a standard approach bank. So what you see here on this slide, we have a slide which visualizes this very well. You have two blocks, which you can see here on the right side, two green blocks. The large green block would be what a standard approach bank has at the moment to put aside as risk-weighted assets, while the smaller green block will be what a IRBA bank at the moment must reserve as risk capital. So you see there is quite a big difference. Now the regulator has said for the output floor, I want this to be a level playing field, so the IRBA banks have to put aside at least 72.5% of what the standard bank does. So that means this is the little gray area which you have here, that this is the additional risk-weighted assets which IRBA banks will have to come up with in the future. So as of January next year. So that is good news for the cooperation between banks and insurers, because we will need more insurance. We have more risk-weighted assets, we need to reduce them, so we will need more insurance. However, the regulator has not only stopped with the output floor, it has also introduced an input floor. And what does that mean? That means that they have thought that for modeling of the LGD, of the loss given default, all banks need now to have 45% for financial institutions such as insurance. And why this is an issue, we will see in the next slide, because here we can see how is the calculation of these risk-weighted assets really done. So you can see for the uncovered part very clear, you have the exposure at default, which you multiply with the risk weight, so LGD-PD. What happens with the covered part? For the standard approach bank, the bank will apply the risk weight given by the regulator. So as Carol just said, the 20 or 50%, depending of the rating, of the grantor to the assets. And will substitute this with the original risk weight which they had for the borrower. The IRBA bank will substitute PD and LGD. We have to substitute both. We cannot just substitute one. We have to substitute both at the same time, meaning the PD for a low-rated borrower will be very good, because the PD of the insurer will be so much better than the PD of the borrower. And the LGD, I will have to take 45% now. For a low-rated risk, no problem. Everything's fine, because the PD will make up for it. I will reduce my risk-weighted assets, justifying the hit in P&L which I take to pay the insurance premium. However, if I have a well-rated borrower, then the PD will not vary so much. They will be very similar. And the LGD might even be higher, because with the 45%, corporates have only 40% risk-weighted assets. So for me as a bank, it will not work anymore, because the hit I take in the P&L cannot be justified by the RWA reduction. So that means for me as a bank, I will probably, this will have an impact on my buying of insurance.
And this is actually an issue of concern for the insurance industry, because the growth and the capacity that is currently available in the insurance industry to banks to insure risk has been really dependent upon the diversification of the portfolio of risks that is shown to an insurance company. If we find ourselves in a position where only the worst rated risks are going to be brought to the insurance market, there is a concern that that will ultimately end up reducing the capacity of the insurance market to insure this type of risk, so there'll be less insurance available in the long term. So that is a concern for the market.
Right. Let's have a look in the timeline. So what can we expect?
So, very broadly speaking, there have been a lot of early adopters who have already implemented Basel IV. The main economies that we are concerned with are Europe and the UK. In terms of Europe, the implementation of Basel IV Day, the D-Day, is the 1st of January next year, as everybody knows. And with the PRA, we are still waiting. It's anticipated that the implementation day is going to probably be January 2026, but we'll have more clarity on that soon. Unknown in the US, but really in our discussions and what we've been working on has been predominantly Europe and UK focused.
Right. Moving forward to have a more detailed look. So what happens with insurance in Europe? What is Article 506 saying in that
So this is
respect?
actually something we're all very, very proud of because we've spent many years, Celia and I have been working together in the ITFA committee for about 6 years now, when it was first identified by members of ITFA in the insurance side that there was this potential issue coming with Basel IV and its implementation in how credit insurance was going to be dealt with. And we felt very strongly that there should be special recognition for the case for insurance when it is being taken out as a credit risk mitigation instrument by a bank. And we were very pleased when ultimately in the final legislation which came out earlier this year, the CRR3, that the Commission and the lawmakers in Europe have given some recognition that insurance should be considered. We don't have an outcome yet, but the European Banking Authority was mandated to review the case for insurance and report back to the European Commission. And then the European Commission, on the basis and on the back of that, could make appropriate proposals for further amendments to the regulations to deal with that. And I think maybe, Celia, you'd like to share some of the things that we've been asking for and, you know, the reason and the rationale for it.
So at ITFA, we think it is not fair that you have the same LGD whether you are lending to an insurance company or whether you are a policyholder. When you are lending to an insurance company, totally correct that you have a very high LGD because there will be not much available in case of an insurance default for recovery because there are these preferred lenders. Who are the preferred lenders? These are the policyholders. So the policyholders have a preferred lender status. This is the first reason why we think that these 45% are not correct. Then there is no correlation between insurance and banks, at least for the non-payment insurance. So this should be taken into account. We have a double recourse. In order to have really a default, if I have an insured asset, I need that the borrower and the insurer both go into insolvency in order to have a default. Then we have the insurance world, the insurers we work with, they are highly regulated. With Solvency II, they have extremely strict obligation as well to manage their capital on their side. So this is an additional point which needs to be taken into account. And last but not least, there is also a further diversification of the risk into the reinsurance market. So all these 5 points lead to the conviction of in ITFA and its associates we are cooperating with, that we should have an LGD for for assets which are non-secured of 20%, for assets which are secured of 10 to 15%. And if you are in the standard approach, Carol just said it would be 50% for an A-rated insurance, the risk weight. We think it should be 20%. So this is our ask. And in order to support our ask, we have carried out extensive research together with our industry partners to show to the regulator why we think this.
Right, so thank you so much for this insight, what the ask is, and to explain that, to have the right context. So, looking into statistical data, so when we are talking about certain key figures, the question is how to collect that kind of data to get an overview on that. And global credit data, Jakub, has the job to collect data and evaluate data. So, let's take the opportunity to get some insights. What you have.
That's right. That's right. And thank you, Carol, Celia, for this nice segue. So, at the end of the day, regulators want to see hard facts in form of data, and that's why our paths crossed, and we're supporting this industry initiative. So let's take a step back and let's look at the GCD, what it is. So we are a non-profit association owned by 50 global banks. We've been around for more than 20 years now, and we are running, at our core, we are running data pools. So basically, we are offering banks opportunity to give us data, and then we give data back. And given we are so embedded in the banking industry, of course, we have to comply with a very strict regulation about IT security and data quality rules. So in the next slide, you're probably gonna see your logo. If not, probably it's time to change it. But we have banks from North America, Europe, obviously, Africa and Australia. Majority of banks are obviously in Europe, but we are a global company, meaning we have relationships, very well-established relationships with all these banks. And I very much like the next slide. Yes, exactly this, thank you. Because it describes very well how we operate, the whole GCD on one page. So effectively, we have member banks who provide us data. Then what we do is we collect this data, we standardize this data, we make sure that all the data quality standards are met. We make sure also that the data is anonymous, and we give this data back to the banks. And then banks use it for various purposes, for modeling, for benchmarking, for stress testing, and so on and so forth. As I said, we operate 4 data pools. The first one, most mature, is related to LGD. So this is where this is also the data pool which is relevant for the exercise, which I'm about to mention. We also have PD rating data pool and named peer rating data pool, where banks can benchmark PD ratings of their counterparties. And given this extensive network of relationships we have and our unique position in the industry, we were approached by ITFA and asked to support the industry efforts. And that's why we entered into this project with ITFA. And the next slide will describe it in more detail. So effectively, we operated in this context of Article 506. So we needed to find defaulted exposures where credit insurance was present. That was the idea. And we did that. It was a very comprehensive exercise, which I will describe using numbers in a second. But this exercise, in my view, was quite conclusive, and meaning that it, by the use of data, we did showcase that this credit insurance product is robust, and that the potential losses in the form of LGDs are small. We provided an article which was shared with different stakeholders. Now, when it comes to numbers, so we got data from 9 banks, 9 global banks. These banks, just to show you how large this exercise was, these banks, in terms of total assets in Europe, they cover 30+%. So it was really significant coverage in terms of data collection. We've managed to find 150 defaulted facilities where credit protection was present. So it seems like not a lot, but given defaults are not common, this is actually a very large and statistically significant number. And within this 150 defaulted facilities, banks have made more than 1,000 claims. Now, what's worth to emphasize that we, across this universe of data, we haven't found a single case where borrower and subsequently insurer would default under its credit obligation. And in the next slide, we'll show how common this credit insurance is. So basically, it's used across all different industries. So mining, utilities, manufacturing. So it's really, really common in the economy. And in terms of defaulted amount, we are looking at more than 5.2 billion euro. And let's not forget that this is defaulted amount, meaning that performing amount is at least 2 orders of magnitude bigger. So it's a really product which is really used, and the exposures are significant. Mm-hmm. And in the next slide, I will show you the key results. So out of this 150 facilities, 94 of them were resolved. What does it mean? It means that all the workout procedures finished. So we know exactly how much money was lost. And for this 94 defaulted facilities, typically on average the covered portion was 50%, so that's how much was covered by the credit insurance. And the LGD on this covered portion was 6%. Now you may ask, how is it possible that it's 6%? But at the same time I said, well, that insurers did pay at all times. But this is because discounting. So typically, of course, it takes a bit of time, several months before the claim is made, and then it takes several months to get the money back from the insurers. So it's just an effect of time value of money. When we look at the nominal losses, so basically losses without taking into account discounting, the LGD is 0. So effectively, all the claims were paid, made by the banks. So that's quite robust statistic given 94 defaulted facilities. Mm-hmm. And when we look at the claims data on the next slide, so we collected more than 1,000 claims, and 100% claims were paid, and insurers did pay out more than 1.2 billion euro. And despite the fact that typically the time for insurers to pay is a bit longer, the average payment time was 70 days, so just a bit more than 2 months, which is, I would say, very quick, given all this aspects of workout procedures. Now, these numbers which I described, they provide overview of this data collection which we performed for ITFA, the very comprehensive one. But at the same time, we operate data pools which have 20 years of history. And in the next slide, I will describe what we found in our internal data pools, where we have data contributed by 50 plus banks over the last 20 years. So we found only 34 cases where insurers defaulted under the credit obligation. So let's not forget that credit obligation is below policyholder position. So this data should be looked as an upper bound in terms of losses. So 34 cases, defaulted exposures approximately 1.3 bill, and LGD, so basically losses on this direct credit obligations. I want to emphasize again that this is direct credit obligations. It has nothing to do with policyholder level, were 15% on a discounted basis. And the discounting was quite heavy. As you can see on the slide, it was Euribor 3 months plus 5%, so quite heavy. And then if we look at EAD weighted, it's just 7%. So this difference between 15% and 7%, it tells us that when it comes to large exposures, the loss is even lower. So basically, large LGDs are typically correlated with smaller exposures, and we clearly see through this data the effect of regulations like Solvency II and strict regulatory oversight from EIOPA and other bodies. So if we go to the next slide, we'll also see how, let's say, safe this market is. So it's very uncommon to have insurers defaulting. So we also have PD rating data pool where we collect snapshots of banks' portfolios, and we, on average, in each snapshot, we have more than 2,500 insurers, and we track them over time. And just to give you perspective, there are circa 9,000 insurers in Europe, and so basically we cover roughly 25%. We observe 25% of exposures to insurers. And out of this number, the observed default rate was less than 20 basis points. And to the best of my knowledge, this is the less risky industry out there. And let's not forget that typically, if insurers default, these are typically small insurers which do life insurance, for instance. So this is a very, very safe industry. So I will conclude here.
Yeah, so thank you very much for all the insights. And now looking into what is the impact? What are the effects now coming up? And Celia and Carol, I think it's useful to have a view on that. So what are expected impacts here? And we really have time enough to look into that into detail.
Yeah, so I think if we could go back to this amazing survey that ITFA and IACPM conducted last year, and the question that was asked of banks last year, taking into account this was at that time on a horizon planning with the D-Day for Basel IV still quite far on the horizon, but banks were asked, how do they expect Basel IV to impact usage of credit insurance before and after Basel IV. And looking at this slide, you'll see 3% of respondent banks believe there'd be a substantial reduction in their take-up of credit insurance before implementation of Basel IV, but 18% of banks thought there'd be a substantial reduction once Basel IV was implemented. I would be very, very interested to see what the actual situation is now that we are just a few months away, certainly in Europe, from implementation date. So I was thinking maybe Celia could provide some color here on what she is actually seeing as a European bank who uses insurance for capital relief.
Yeah, as you say, Carol, of course we can feel already the impact because our modeling departments are not waiting until the 31st of December in order to put new models in place. Of course, these models are in place. And every transaction which I do now, which will continue next year, has already the new calculations. And I can clearly see that this has an impact. And that for me, using insurance for better rated risk doesn't make much sense anymore.
And we are also, just as an insurance broker in this area, in London, we are seeing and hearing from insurers that they are seeing an impact already. So I think in the run-up to the implementation date in Europe, certainly, there has been some impact on buying patterns of banks. So I don't know if we have another one of our lovely slides that we could maybe look at here from ITFA and IACPM. And again, this is fairly bleak projection which came out last year when asking banks, what did they think? And we're looking here really at how is the insurance market, what's going to happen to our market that I work in as a broker and for insurers in the long term with Basel IV. And what you will see here is of the banks that replied, nearly half of them felt that they were really worried about how the sustainability and future of our market would be. And the more important thing to see is that the greater percentage of those banks are European banks who had that outlook. And that is because it is predominantly in Europe that banks have had the advantages to gain for regulatory capital benefits from the use of insurance. So this is a concern we have. We mentioned earlier about the concern about the impact on banks, because at the end of the day, when looking at the impact of Basel IV, there's so much has been about how is this impacting banks, whereas our little known area of insurance that's not so public facing and sits silently behind and supporting banks is not something that people were really focusing on, apart from the ITFA initiative in our industry, which took this up 6 years ago. But this is actually an issue. Banks have been supported silently by insurers to increase their lending, by insurers giving this insurance for a diverse portfolio. And so the concern of this retraction is if banks are not able to show that diverse portfolio any longer because it's not economically feasible for them, that you will have this contraction. I don't know, Celia, do you have anything to add there?
What does that mean, basically, in short? And I think we all need to realize, what does that mean for the real economy? So there are two possibilities. Either the regulator picks up the suggestion from the business world, from ITFA and other associations, and implements a better LGD, more appropriate. Then, of course, European banks can leverage on their extensive know-how and buffer a little bit the impact of the output floor and continue their lending to the industry, to the European corporates. If they decide not to do that, because they don't want to deviate from the basic rules of Basel and not fix this omission, that would mean we have less lending capacity available, because we cannot for all of our business rely on insurance anymore. That means mainly this will hit SMEs and non-rated, non-listed companies, because they cannot have recourse to the capital market for their lending. And it will mean that also lending becomes more expensive, because we will have much more risk-weighted assets which we will have to remunerate. So that's the outlook.
So that's the output. So we have enough time left to get in some additional questions, and I would like to encourage the audience just to send us in the chat your questions regarding this important topic. However, one question is, what can we do to jointly give an update, and what is the time frame next, and who can look into what is coming in the next days and weeks?
So actually this is a very important month. You may recall from the slide on Article 506 that the EBA was mandated to report back at the end of June. They had so much on their plate, it was a deadline that was very difficult for them to achieve. So part of what we've been doing since February with GCD is providing information to the EBA in the hope that they will come up with something favourable for us. But that report, we understand, is going to be published later this month. So when we have that report, we will see what the European Banking Authority suggests, and from there will be an opportunity for us to know what steps we have to next take, and that is very much dependent on the approach the EBA adopts. We will then need to engage with the European Commission to see what may be appropriate or what can be done off the back of that report, whatever the report says. And I think at that stage, once we have that report, is the time for the next report back to everybody. We'll know what happens next. Yeah, and I think Celia.
I think PRA is also having a publication today.
Yes.
So as we are at the moment here, we don't know yet what it says. But on both topics, of course, ITFA will inform its members through news flashes and through their website of what is happening. And of course, Schumann, being an esteemed member of ITFA, will get the news fresh from the press.
Yeah, and we really looking forward to our intense cooperation here because it's for the benefit of our customers, of the members, to understand what's going on in the market in terms of that important topic that we are discussing here. So I think we touched a lot of details here, and there's a question, Jakob, for you. Um, uh, well, you did this survey and provided that in that context of requests coming from ITVA to get these numbers right. So could you again tell something on updating? When are you going and how are you going to update the data in the data pool? And maybe if you could describe that a little bit.
Yep. So we provided all this evidence to the EBA, and also we did publish a report which had all the high-level numbers which I was showing earlier. We, of course, within GCD, we collect data on the LGD side every half a year. So basically, all this data pool is growing over time, and obviously, in the the unlikely case that that the regulators will not, or the European Commission will not fix this omission, then obviously we'll be supporting the industry with more data, which I hope they will see that it's basically conclusive based on my experience.
Yeah, and another question is regarding representativeness. Maybe if you could say something on that. You gave a slide overview which banks are participating and giving data. The question here is what is the representativeness of the database that you have on a global level, and how do you expand, or are there any plans to expand the database, maybe more intense to various other world regions?
So maybe I'll cover representativeness at two levels. So on the special data collection, which we've done, so we are effectively covering 30+% of European market in terms of total assets. So that's extremely comprehensive. In terms of globally, so we have banks from Europe, Africa, Australia, and North America. But at the same time, let's not forget that these banks, some of them are very large, some of them are medium, some of them are small. These banks have exposures all over the globe. And the other day I was checking, and we have basically defaulted facilities from more than 180 jurisdictions. So whatever country you're doing business in, we probably have data to support it. So we are truly global in terms of data collection.